I'm Luke Alexander, President and CEO of Newcore Gold. Newcore is a district-scale exploration project in Ghana. Over the next kind of 15 minutes, I'm going to highlight why I feel we're undervalued relative to the project value that we've got and the district-scale exploration upside. First, I'll just leave you with a few numbers to think about as we walk through the presentation. We're currently trading at about 0.1 times our NPV of the project. That's at a $1,650 gold price, currently trading at about $15 per ounce in the ground. And one of the things that we'll get to near the end of the presentation is the optionality that this project has that I don't think you get with a number of infrastructure constrained projects around the world. Three numbers we've been talking about the last couple days: $100 million of CapEx for 100,000 ounces of production, $250 million NPV. So I want to leave you with those numbers as I walk through this presentation to think about, and hopefully by the end you'll recognize the deep value that we've got within Newcore. Like everybody else, I'll be making forward-looking statements. Encourage you to go to our website. While you're at our website, I'd also encourage you to sign up for Twitter and Facebook and LinkedIn. We put a lot of good content out there that people really enjoy. So Newcore, again, district-scale exploration project in Ghana, backed by a Tier 1 management team who are truly aligned with shareholders. We own 24% of the business, and we all wrote checks alongside investors. My current cost base is exactly where the stock is trading today. We're also very strongly supported by deep-pocketed institutional investors and the capital markets. But at the end of the day, you need a great asset to really build a company, and our entry project, again, is a district-scale exploration project with a huge amount of optionality. In terms of drilling, we just completed the largest ever drill program on the project, 90,000 meters. On the back of that success, we were able to raise $5 million with our existing shareholders and new shareholders to kick off a Phase 2 drill program. I think Dave just highlighted why Ghana is such a great jurisdiction to operate in. If you look at what Asante did over the course of 12 months, they took a brownfield project, brought it into production. I'd say try to do that in North America, it's going to take you 5 to 8 years. The Ghanaian government is extremely keen on seeing projects built and brought into production. At the end of the day, though, I say don't listen to what I say. Biased CEO of a single asset company. Look at what Newmont and the other majors are doing in country. Newmont is currently investing another $850 million into Ghana. That will take their global production from roughly 14% to 20% of global production. For them to have that kind of exposure to one country, I think speaks for itself. We're situated on the Sefwi-Bibiani Belt, 200 million ounces of gold historically discovered in Ghana. You've got the Ashanti Belt, and then again the Sefwi-Bibiani Belt. Great neighbors along trend from us. Again, Dave Anthony, who just presented, they sit 50 kilometers to the north of us on the same Bibiani shear. 5.5 million ounces of historical endowment there, 6.5 at Bibiani, and then 20 million ounces at the Ahafo asset, which is Newmont's asset, which they're pouring another $850 million into. As I mentioned, we've just completed the largest ever drill program on the project, 90,000 meters. That more than doubles all the historical RC and diamond drilling that's been completed. We really wanted to accomplish 4 things when we kicked off this program. We wanted to expand existing resource at all of our known deposits. They all remain open along strike, so systematically stepping out 50 to 100 meters and adding easy oxide ounces, very valuable ounces, which were highlighted in the PEA, is something that we accomplished as part of the program. We also wanted to go back to previously drill-tested areas that had limited results, make further discoveries, and move those towards the resource category. Kwachikrum would be the best example of that. As part of our first 20,000 meters, we put out a 1.4 million ounce resource and a maiden resource at Kwachikrum. We then wanted to make some greenfield discoveries. We allocated 19,000 meters to new targets, and we're excited to have announced 3 new discoveries this year. And then lastly, we wanted to start testing the sulfides, which sit below that kind of oxide transitional zone, and we've made multiple high-grade discoveries there. In terms of the project itself, again, very large deposit, 216 square kilometers. These are the shears that run through our property and head north up through Toronto, Bibiani, and beyond. If you add up the total strike length of all of that shearing, it's about 100 kilometers, 25 targets identified to date, of which only 4 make up our current resource. In terms of expansion drilling, which was the first thing that we wanted to accomplish, good example of that would be at our Boeing deposit. Currently sits at about 500,000 ounces. When you then look at this model here, what you're looking at, these are the pits that currently constrain that 500,000 ounces. We've extended by about mineralization by about 400 meters to the north, mineralization by about 1 kilometer to the south, so pretty easy to do the math on what that'll potentially add. Don't have enough time to go through our other deposits, but stepping out along strike is something that we've done at all of those, and they continue to remain open, so very easy for us to expand that. We were also focused on up dip and down dip drilling, looking to widen and grow the overall size of the pits. Good example of that would be this hole did not exist when we put out that 1.4 million ounce resource, so 95 grams over 2 meters, 13 over a meter, as well as this hole here didn't exist. So those are the ways that we're expanding existing resource. Second thing, and again, Dave did a great example of also highlighting Toronto, and we use it in our presentation. We wanted to start testing the sulfides below that oxide transitional zone. What you're looking at here is a long section of our Enchi project, comparing it to the Toronto mine. What we've done is superimpose the depth of the oxides. The average vertical depth of the pits on our current resource are only down to 63 meters. For the first time ever, as part of the 90,000 meter drill program, we started to test the sulfides and drill down below 125 meters, and we've started to have some very good success. As we then superimpose that at Toronto, and again, you can see pretty clearly that there's big opportunity for higher grades and more resource at depth. To put that in perspective, Asante's mining down at 800 meters and have drilled down to 1.2 to 1.3 kilometers. Going back to our property now, I'll take you into Nyam, which is where we've had the most success from a deeper drilling perspective. What we're looking at here is a cross-section in this hole number 48 here. As we got down to about 175 meters, we hit 4.5 grams over 13 meters, 7.5 over almost 8 meters. These are the kind of higher grades that we're ultimately looking for to start to highlight the underground potential to complement the open pits on our project. Hole number 45 sitting 500 meters to the north. Again, as we got down to similar levels, 5.4 grams over 9 meters. When I now pull you back and show you this from a long view perspective and zoom in a little bit, what you're ultimately looking at here is 5.8 grams over 7 meters, 5.6 over 8, 5.4 over 9, 5 grams over 8 meters. Again, these are underground type mineable resources. And importantly, we're still only down to about 250 meters below surface. So we, with confidence, can now start talking about how we think we've hit one of these high-grade shears plunging at depth. Sitting 500 meters to the south, again, we've got 3.2 over 9, 7.4 over 8, 3.5 over 9, 6 over 6. So we think we've hit another one of these high-grade, zones plunging at depth. And I'd encourage anyone to chat with Greg Smith, who's sitting in the audience, about why he's so excited about this. And one of the key things for us is that this includes all of the drilling that we've done here. So when we look at it, no drilling in this area and really limited drilling in this area. So this is one of the areas that we're going to target first with this phase 2 drilling that we've just kicked off. Third thing was we allocated 19,000 meters to new discoveries, and we've made 3 new discoveries on the project. Not going to have time to go through this in detail, but one of the key things with all of these discoveries is that they sit right around our main infrastructure. So these aren't stranded discoveries 40, 50 kilometers away. Siyum is about half of our 1.4 million ounce resource. Made a discovery here at Siyum South, made a discovery at Tokasea. When you look at the size of these areas, you can start to see the potential they have in terms of significantly growing our overall resource within the Sium complex. These are all, cross sections that I'm not going to have time to go through. Our 1.4 million ounce resource, what feeds that is about 110,000 meters of historical drilling. We were able to include about 20,000 of our current drill program. That leaves us with 70,000 meters that will go into future economic studies and resources. Of that, about 40,000 is direct resource expansion, so stepping out along strike, up dip, down dip, that we think will immediately add to this 1.4 million ounce resource. So you take 40,000 relative to 110, it'll add about, we think about 40% that, getting us to 2 million. Just like to give you a back of the envelope calculation, because we always get asked what we expect in terms of the resource in Q4. The other 30,000 meters that's not going to get immediately captured within that resource is the new discoveries at depth, the Tokasea discovery, the Sium South, but all of that adds fundamental project value and hopefully highlights to you the district scale potential to grow to that kind of 3 to 5 million ounce resource. So that's the asset. Again, couldn't get in too much detail. In terms of the team, again, we think as shareholders first, we own 24% of the business. We're also very strongly backed by deep-pocketed, long-term focused institutional investors. We've grown that from 0 to about 40% over the last 2 years. Franklin Templeton's our largest shareholder, about 9%, Ruffer 7%, Merck, SSI, Earth, all names that I'm sure you know. Also very well backed by the capital markets, 5 brokers currently covering us, no warrants. We did just raise $5 million, so we are fully funded to be able to do our phase 2 drilling, resource update, and then have cash to run right through into 2022. One of the things we've started talking about, and given the lack of questions in the last one, I'm going to run over time here and fill it with this instead, is the optionality that our project has. We put out a PEA last year, and the base case of 1650 outlined very robust economics. If we want to look at a 1750, I'll go back to those 3 numbers that I talked to you about earlier. $100 million of CapEx for 100,000 ounces of production for an NPV of $250 million. For those in the audience who like to look at capital intensity, you're all of a sudden looking at a NPV to CapEx ratio of 2.5 to 1. As you meet with companies over the last couple of days and the next couple of days, I would encourage you to compare their projects to that capital intensity measure, and I think that's one of the things that's a real differentiator from us. We can produce 100,000 ounces with the cash flow, grow that to 150 and beyond as we discover more sulfides, bring a mill in through cash flow. The infrastructure-constrained projects around the world in northern BC or the high Andes, where you need $500 million to $1 billion of capital to get them into production, don't have the optionality the Enchi project has, and I think that's something that really differentiates our project from a number of others out there. With that, in terms of catalysts, our phase 2 drill program focused on some of those higher grades at NIAM is where we're going to start. We've got additional met work coming out next month. We will then get a mineral resource out in Q4 of this year, and then we'll start to get drill results as they come back from this drill program. With that, I left exactly a minute for any questions.
Great presentation, Luke. Nice one. Why was the focus historically only on the oxide, not on the sulfide ounces?
Historically, they're very low-lying, low-hanging fruit in terms of exploration. So trenching, RAB drilling kind of identified significant oxides across the project. Following up with RC drilling was a big part of the reason. The other thing is one of the key things that differentiates projects is the depth of the oxides. Our oxides will go from anywhere from 20 to 120 meters. So very easy to drill them out. And obviously oxide projects, heap leach projects, tank leach projects provide very robust economics. So that was the historical kind of reason for targeting those ounces. a lot of bang for your buck from a drilling perspective. As you know, RC drilling, for us, it's $80 a meter. Diamond drilling's $230, about $230 a meter for us.
Right
Thank
on.
you.
Well, with that, very well spoken, Luke.